What's good, YouTube? This is a video not to be missed, an hours long trading course. So make sure you smash that like button to save this video. We're gonna go over trading the market, some strategies. This is a course I made for my students a few months ago, but I took it down after 5 days because I was planning on making a brand new one. I'm gonna make it public here for you. Now the question will come about, I paid for this course, why are you giving it for free? Well guys, not many people have paid for this because I only had it live for a few days, and most importantly, any package I have on Monopoly Trading School, people don't pay for the course, they actually pay for the chat room access, which is where most of the learning is done, and I'm there every single day. So hopefully this here gives you some basic knowledge and even advanced knowledge, because this course goes over the strategies I use on this channel. So for those viewers that follow me here, hopefully we're up to date after this course when you see me trading on this channel, because this goes over really my thinking and knowledge when I'm trading. Enjoy this, and I'll see you guys at the end of the video. Hello guys, so welcome to the course. So in this course, what we're gonna go through, you're gonna get 4 or 5 lessons from me, and then we'll get into more details. So if you're trading prop accounts, or accounts where you have a max drawdown limit, right? And maybe this is your own capital you're trading with, but you want to limit how much you can lose overall. I'm going to give you the answer here. We're going to try and minimize risk while maximizing returns and how long you stay in the game in the long term. Because many traders enter this field and instantly their account gets brought down by mistakes they make. So let's imagine your trading account has a $700 max loss. That means that's the drawdown limit. That's how much you can lose before you decide trading is not for you, or before you the fund itself that you're trading for decides to take you out and close your account because you're now losing rather than gaining. Or let's assume it's 4,000. That's your max loss on the overall account of yours, or capital. So if you have $80,000 trading account, what you can lose is 4,000. How do we first of all approach it? Well, guys, remember here you're gonna learn discipline, minimizing risk, and trading like a professional. So here's some rules, and there's only 4 things you have to follow in order to stay in the game and become profitable. So rule number 1: increase the max loss by making more steadily. So if your max loss is $700, let's say you've got a 14,000 trading account and your max loss is $700. Well, I want to increase that max loss to now $1,000 max loss, or 2,000 max loss. So I need to grow that account, okay, so I can have my max loss increased by 1,000 or 2. So that gives me room to increase my position size and to make mistakes without being blown up and destroying the account. Okay, similarly for the 4,000 max loss, I want to increase the max loss by making more steadily. So how do we do that? Well, the first thing we have to do is we have to understand the account itself. Avoid trading really volatile stocks at first and focus on blue chip stocks. Okay, blue chip stocks are basically stocks that are well established. They always have demand, buying pressure, and usually blue chip stocks will be in the S&P 500, okay, or the Nasdaq 100. Now the Nasdaq 100, these are stocks. Let's just pull it up. Pull up the stocks in the Nasdaq 100. These are tech stocks usually, and they always recover. But we will choose the ones we're actually familiar with and we always know will have volume. I mean, Microsoft, Netflix, right? When the market drops, it drags everything down, but then when it recovers, it lifts everything up. Now, we're going to cover that in this course down the line, but avoid trading volatile stocks. Stocks are manipulated by retailers. What we want to trade are stocks that have majority of hedge fund holdings, but also there is room for retail trading. And we'll go over that in the next lesson. Don't use leverage. Okay, so if your account is, let's assume your trading account is 80,000. That's what your capital is without leverage. And then with leverage, you have $250,000, let's assume. or 500,000, depending on the leverage amount, whether it's 1 to 5. Okay, so that's with leverage plus leverage. So imagine you have 250,000 and you're trading with 250,000 when your max loss is 4,000. When you trade with big sums of money like 250,000 with leverage, that right here, $4,000 max loss, that's $1 move against you if you're trading blue chip stocks. $1 move. You don't want to do that, right? You want to give yourself space to grow steadily and slowly. So don't use leverage and always trade with half your account size for the first 2 4 weeks. So if your account size is 80,000, okay, make sure you trade with 40,000. So don't use the full 80,000 when trading. Yes, you're going to be able to trade 500,000, 250,000 worth of trades, but that's a quick way to blow up the account. We don't want to do that until we grow the account steadily. So 80,000, we want to divide by 50% whatever our account size, uh, and trade with half our account size. So 80,000, let's say we can afford 1,000 shares of Apple with 80,000. We're not going to trade 1,000 shares worth of Apple because Apple moves by $2 $3 on daily basis. That's the average volatility. What we want to trade is 500 shares of Apple, and that will be about 40,000, let's assume. So if and when Apple goes against us by $1, we only lose $500. But if it goes in our favor by $1, we make $500. Now our max loss over here has increased by 4,500. Now that's how much we can afford to lose. And we continuously do that for a period of 2 to 3 weeks to grow the account slowly so we can increase our account size and allowing us to have max a bigger loss. Okay, so don't use leverage and trade with half your account size for the first 2 weeks until you achieve point one, which is to increase the max loss by making more steadily. That's if you have limited risk of how much you can lose on the overall account of yours, whether it's personal or there's a prop account, funded account, etc. 4, set a hard stop loss. Now, for me, if you followed me for a while, you would know that I don't use hard stop losses. But because these are accounts with max losses, you need to use hard stop losses and be really disciplined because sometimes you will time your entry wrong. So let me show you how to do that. Okay. So here is a chart. Well, we'll go through that in risk management. I mean, if I entered right here at 172.28, I want to put my stop loss right under the wick of this candle. Usually that's where you want. That's the support level. You can see that it found support. So I want to put it right under here at 17160. If I entered at 172.27, I want to put it at 17160. If I lose, well, so be it. I'm going to take the loss and I'm going to wait for clear direction and then enter again. Okay, so that needs to be adhered to and really try to time your entry. But that's why we have to practice for at least 2 3 weeks, especially if you're not used to trading blue chip stocks, and just focus on the kind of setups that you're about to trade with. So that's the intro. Let's get down to business. So how do we find stocks to trade? Well, now that we're trading blue chip stocks, initially what we would do is open up the broker, right? And you will have a scanner here showing you stocks that, gained in value. But these are small cap stocks. I mean, look at it. This is $8. This is $1. This is $4. These are very volatile. GME, obviously, that's a Reddit stock. So it's a retailer's trade stock. So it's best to avoid these kind of stocks unless you have 100%, sure game when trading these. So the scanner tells us which stocks have gained, and usually what I'd like to do is look at these losers instead, because when trading blue chip stocks, you really just want to buy the dip instead. Of course, assuming the market is upwards and the news is pointing upwards. So that's one way to find stocks. Other ways, you can just Google NASDAQ 100 and, there's 100 stocks here in this Nasdaq 100 indice. So big names, Zoom, right? T-Mobile, Starbucks. A lot of you are familiar with these: PepsiCo, PayPal, Peloton, Paychex, Nvidia, Micron, Netflix, right? These are big names. Intel, Alphabet, Google, which is what Alphabet is, eBay, Electronic Arts, Cisco Systems, okay? These are big name. Activision, Amazon. You know, stocks like Amazon always recover. So if we just Google it and just have a look at Amazon. Now, surely the market currently is kind of dropping downwards, but every time, right now, Amazon is a good buy, right? When you look at Amazon, you know there's a reason why it's sold off in the last 5 days. Now, why this stock sold off is because there's fear in the market currently as I'm making this video, and that's of interest rates, Feds tapering. So interest rate hikes usually scares tech stocks. So you can see right now it's down. Once the fear disappears, what I want to do now is I actually want to come in today and look at buying the dip. You can see pre-market, it's up by 0.14%. So it's green, opening up a green. That means the fear is fading slowly. So this here is a kind of stock that I'd like to trade just because, well, these are anchors of the stock market. They always have to recover. But obviously, we will have to use price action to our advantage here to make sure that there's strong pressure and it's holding strength. So these are the kind of stocks I'd like to trade. How do I find them? Well, it's simple. I load them up to a scanner. It could be on your phone, your stock mobile app on your iPhone, and every day before market open, check them to see how they're doing. Okay? Now, other ways you can find stocks if you want to trade earner reports is you just go to Google and Google earner report calendar, as a lot of you are aware of at this stage if you follow me on YouTube. And you will have every day the stocks that are releasing an earner report. Earner reports just show you basically how a company's doing. And they release it pre-market. So there's news. We know news moves the market. We know news will fluctuate the stock. So that's another way of finding stocks. And there's always a way. Otherwise, you go to Yahoo Finance and just look at what's going on here. Now, there is news coming up every day in the market for the overall economy. If the overall economy is doing well, whether it's jobs report coming out, payroll, etc., etc. But you'll know all about that when you're part of the chat room on the inside, because the mentors will share with you. So let's talk about how we know if a stock is below support, yet it's not actually going to be downtrending further. But some stocks will go below support just to bounce back. And that's something you'll see in a stock called Tesla. Now, remember we had a watch list here of all these stocks, Tesla, and I just ended up searching it to see what's happening. I came here to Google search, matter of fact. Now you see how it's downtrending. It's actually been downtrending for a year, almost a year. But even if it's downtrending, and even if we look at the 1 year or the 5 years and we say to ourselves, you know, this stock is just plummeting, I don't believe it's going to continue upwards anytime soon. Well, this is not our problem. Our problem is to take $5 to $10 from each stock and we milk it. So here is Tesla. Now you see Tesla, guys. If we look at the yearly, it's just, you know, you can't even map it to any support here to the left hand side because there's nothing, right? This area is just empty. So there's nothing to map it to. You go 5 years, you say, 5 years, we see something. Well, that's where you're going to map your support to, is the 5 years. So let's go here. Let's load up our Tesla. Okay. Now the purpose of this lesson is to identify whether a specific stock is worth holding. Now remember, even with Tesla, we have something called earner report and economic data. So we have to be careful of these. These are very important, so we can highlight them here. Okay, earner reports, economic data. We need to know when Tesla's earner report will show up. So let's go to the NASDAQ calendar. This is the first lesson of this course, and economic data as well. So once we know that, we go to our 1 year. Okay, so we're using the hourly here. I think this is a better system when we use hour instead of minutes for swing trading. So 1 year gives us the same kind of, let's go here as well, Tesla. So Yahoo Finance. The charting can be done anywhere. The execution is all that matters. That's all you need. So 5 years, remember what we said? Let's go full screen. This is Yahoo Finance, by the way. I like it just because it's clean. We only use the line graph. No candles needed. Let's draw. Here's our line. And we're way below our support. This is our support right here, guys. Okay, look at this. We are way below our support. So in the next lesson tomorrow, when the market opens, I'm actually going to take a buy position on this stock. Okay, I'm actually going to take a buy position, and we're going to make a video about it, because that's exactly what this stock is telling me. This is a buy position. Now you see how the price is under the support level. You see it's 123.5, and here's where we are, 122.50. So we're way under it by, I think, $1, $2. Okay, that's our support. Now if you really want to be accurate further, let's go to the bottom of the peak, the last peak. Okay, it tells us we're still under it because it's 123.50. So that's good. So here's what's happening. As the price pushes down, imagine this, guys. Imagine this is a balloon, right? A balloon that's not inflated. You know when you put your hand, let's say you stretch it out and you put your hand or even your finger, you see how the balloon just, because it's made of plastic or elastic, it just goes kind of that way, right? Or even an elastic band when you put pressure. Well, it's the same thing, guys. As this starts coming down below the support level, this thing starts forming. What is this thing? This is pressure. All the buyers are building up, because as soon as we enter support level, you got to understand, as soon as we enter support level, you have this elastic forming where you can look at it like a spring. So this spring is like buyers waiting to buy, because the moment we break support, you kind of form this spring, because all the buyers are piling on, and all the sellers or all the people that have shorted will start taking profit. So what do you think is going to happen? Well, it's going to pop back up this way. Where is it going to go? It's going to go to the nearest resistance. Where is our nearest resistance? Well, this is too far off, so we can't use that as the nearest resistance. So we'll just use what we have here, which is one right here, 138. Again, resistance is the bottom of these peaks, these little peaks over here, because we can't even match it here because it's just empty space. So that's where we're going to go. And what could happen next? Well, next, one of two things will happen. Either we establish a new support here, or we continue down. Now that's one scenario. Or if we establish a new support, we can push up. The moment we break this area over here, the next resistance becomes, and we have to come back again and say, this is an opportunity. This is the next resistance. So see, the moment we broke above the resistance line, which we identified here first, we found the next resistance. But here's the mistake a lot of traders make. Once we break above, let's assume tomorrow, as I said in the next lesson, we're going to buy this. What's going to happen? Well, this is going to bounce, and the moment it reaches this number 138, because remember we're at 123, moment we reach 138, sellers will arrive, all right, because everybody wants to take their profit. So what do we do next? Well, you have a push this way and then a come down possibly. So we don't do anything. We want to see again, does it break the support one more time? This time if it breaks it, then we find another support below it, just like we did earlier. Or if it decides, you know what, I don't want to sell, I don't want to go down further, well, it's going to break above the resistance line, this line right here, right? Well, what's next? Well, next you say, now it's time for opportunity. I'm going to wait for a retracement. That means, so here's what happens usually, guys, okay? When a breakout happens in a stock, let's say here's our resistance, and a breakout happens, so the price goes above resistance. What you have is a retracement back down, okay? So it doesn't continue up. No, this is not a bull market. It actually comes down to test the resistance, and then it goes again. Where will we be? We'll be right here, guys. All right, we'll be right here as support, waiting one more time. We don't buy it when it breaks out over resistance. We'll be at support, waiting one more time to buy in with a buy order, because we believe this pattern is going to form. This pattern right here. So we'll be right here waiting to buy. So let's go over it again. Okay. Let's go right here. Okay, so what we've seen is the price is sitting at 122.20. What that means is I'm gonna have to put a buy position right here somewhere, okay, at this price, 122, 121, okay, or 120. I'm gonna have to put a buy position. Let's use green instead, just to reflect it better. So tomorrow when the market opens, I'm gonna have to buy this because I believe the market will push up to 125, rejects, comes down again, and then shoots all the way up to 130. Right? This is a retracement. So the market always has to retrace after dropping. When we see a market or any stock dropping like this, big gap, sells off, there's something called retracement, right? Retracement, where the price of a specific asset needs to correct itself. So the fair price is 130. That's the fair price of this specific stock. So that's what fair price is. It's a retracement. And you look at it, I mean, when you see a big gap like this, just get a line. If you're not good at technicals, get a line and put it halfway through the big gap or big drop. That tells you this is the retracement level, and that's actually going to be Fibonacci 50% retracement. So the fair value of this is 122 or 131. So we can make $8 to $10 on this trade. So as you know, there's two styles of day trading. There's momentum trading and there is position trading. Momentum trading can also be viewed as scalping. So this is a momentum trade. The market is heading in one direction, or we believe the market is targeting a specific direction. We take a trade with it, or we simply trade a breakout or the candle. But essentially, if the market was heading upwards this way, okay, if the market was heading this way, we end up here. This is a momentum trade. Okay, this will be closed on the day. If the market is heading this way and we're shorting, this is a momentum trade. But if we decide, you know what, I'm going to enter a buy position here and I'm going to hold it and close it before the day ends. This is a position trade, but it's also day trading. Okay, so what's happening here is, as we close the last lesson on swing trading, now the market is pushing down and we know our target is 1110. Okay, we established that 1110. Why? Well, because it's a whole number. And we can just look at these candles, the way they behave. We don't have to read the actual candle itself. We're just reading the strength of the market. And we can see the strength is weak. It's pretty weak over here. So what I can do, guys, is open up my contracts. I'm going to give it 3. I usually like to add my stop loss later, just so I don't get triggered while I'm in a trade, right? So we're going to open up a short right here, sell, and we're going to adjust our stop loss, give it to 113. That's 150 loss. Okay, so this is our current trade. And we're right at resistance. The body of these candles act as resistance. But you're going to learn about reading these once we enter the futures sections of this, because it's easier to show you what's going on. You use the body and in some cases the wicks of the red candles, always the red, for resistance. Greens always support, reds always resistance. Okay, don't forget that. So we opened the short because we believe 1110 is our target before any reversal can happen. Okay, so now we simply wait, and we're playing it with momentum. Okay, we're also using the time and sales. We can look at this and see how many people are buying, how many people are selling. Okay, here's a buy order that came in. Here's another buy order. Here's some sales on the red. Okay, red, there's big sales right here. So we don't really need to look at it, but just by reading the price action, we can assume the direction. And don't forget, day trading is all about speculation on the price and where it's heading. This is a weak candle. This candle will push down to 111. Because as I said, we've established that 1110, a whole number, needs to get tested, or 111, a whole number needs to get tested before it reverses. Is 11270 a whole number, the price we opened it at? No, it's not. Okay, it's not a whole number. If I can go to 1112 or 112 and I take 70 cents on 500, that's already a good profit. Okay, but the most important thing is I'm going with the flow here. I'm going with the momentum. I don't need to read my technicals. I can make use of this, however. And by the way, we're 3 hours into the market open, so I'm not trading the market open. There will be another specific video for this in this course, in this category, but this is a momentum trade, and I can switch to go swing trade once we hit the figure I had previously in my swing trade, which is 110, and I can use that as my support level and take profits. Okay, indicator, which is 110. I'd like to get away from this trade by 111. So in $1.80 move, just to be away and closed out with before everybody else. And I can come in here and say, you know what, I believe Tesla has had enough dropping today. We're gonna have to retrace. Here's me entering my trade in my support area and hold number, because it's a psychological area, and I'm just gonna take a $2 $3 move here. If this day trade or position trade doesn't come about, remember this is going to be a position trade, I can hold it and therefore it will turn into a swing trade. Now I can turn a day trade into a swing trade or a swing trade into a day trade, but I can't turn a day trade into a swing trade. Because if I don't close this short and the market ends up just doing this, I'm going to have to wait a long time before it comes back. But if I swing this, i.e. a buy position, and it was a swing trade and I made money instantly, I close it, I walk away. Okay, so it's better to turn a swing trade into a day trade instead of a day trade into a swing trade. The psychology is just different. Alright, here is us coming down and the market beginning to behave for this specific short. Okay, here's 100, another 100. We can choose to take 50 cents, $10, and hence there was no strategy on this trade, as in there was no specific percentage of entry as we did here, 20%, 40%. Actually, we just went in all in and we put a stop loss. Okay, because it's a quick trade. We're not trying to get the best price. Now you can still do it, but I like to be in and out from these trades, especially if I'm late to the party, which is I am, because I'm 3 hours late into the volatility and the drops. Okay, I should have shorted here. But essentially, guys, that's day trading. I'll keep you updated once we reach 111 or close, and we close this position. This is also can be regarded as a position trade, because it's not a scalp. I should be out from this trade by now if I'm scalping, but this is a position trade because I believe the market is coming down even further to 111. Okay, and later on we'll take another position trade once we reach our 110 destination. Okay guys, so let's cover key levels. Key levels are the same as support or resistance. We've covered it, I believe, in swing trading, but it's the same with day trading. We're looking for a price point where it will be an indicator for us whether a stock will break out above the price point, it continues upward, where we can say we're going to stay long, we're going to keep buying, or it breaks below it where we say the market is going to continue down further. So how we identify key levels depends on the candles over here. So we know our first one, if we just look, this is the current price is 140. We know we're going for the body of the candle right here. Okay, that's 141. But is this the key level that we want for a breakout? No, because it's not even a whole number. So if we go to the candle above it that's showing us a wick, you can see 14250 is a key level, and even it's a whole number, as I spoke about in the course. So this is our key level. Anything above it, we can see there's a whole gap to fill to the next key level above, which is 148. So the moment the price decides, you know what, I'm going to break above, you're going to see it push up, come down, test that as support, and continue upwards to 148. So as a day trader, I know if I get a green day, the market is green, we're going to get a push up to 14250. There we decide what we're going to do. So it's the same as support or resistance, but it's just a number where there's a shift in the price movement. So at 142, anything above it, we know there's a shift in the price movement by continuing even further upwards. But at the start, once we reach it, we will get a rejection first. And then traders, if there is enough buying pressure, you will notice there's a breakout above. And currently I'm in a trade on this specific stock. It's a short position, so I'll need to close it before the next key level, which is right here at that support. Again, what we're using is the body of the green candles as support and the body of the red as resistance. And you'll see that in the futures section, because that's where we get into deeper into price action. Okay, so now we are looking to see if this will come close to our resistance, which is 83.66. Again, we identify resistance by looking at the candle that's exposed, and we look to the left and we found it. Yes, indeed, it was exposed. And we use the body of that red candle, because remember, red is resistance, as our resistance or key level. Let's see what's going on here. Good job. Okay, so we're coming close to it. And when a market is like this and you notice these candles or this specific green candle refusing to push higher, just be extra careful not to short it, because it doesn't mean it's ready to go short. The idea of shorting needs to happen at the key levels that we identified. Otherwise, you always wait, especially when a candle hasn't closed and you end up trading it. Try to get it when it retraces back to the nearest support, which is 83.70, as we did earlier. That's the nearest support because there's the candle right here. So I'm gonna go for another long, see how it's gonna bounce. Might not long this, but look, the moment it tests this, it just bounced. This one is closed now and it created a hammer candle, and here's another one pushing up. See? So one thing you need to know is when you're trying to take a trade with a candle like this, just be careful of entering here because you might get stopped. Wait for it to retrace back and touch the body of the last green candle, which has a wick exposed. So if we look at the price action here, this price action is indecisive, but it's bullish. Okay, it's indecisive, but it's bullish. Here it goes, finally pushed. Every time it tries to come down, it pushes back up. Similarly here, if we look at futures, it's the same thing, by the way. Every time it shows us a red, it pushes upwards, and that's because the market is trying to reach a key level. Stocks like Amazon are trying to reach a key level. And that's the beauty of this, is the key level will always try to get tested before any major shift in price action. So currently there is this price action that's very bullish, and every time the candle pushes down, look, next time it touches the body of this green, its sister, it's gonna bounce back up. So when you see that, you wait for it, and you should always wait for it to touch the body of a sister when you see a wick like this that's exposed. Okay, and it usually bounces upwards. If not, it goes to this one. It has to go to one of them. If it doesn't go to this one, it goes to the one at the start, and look, it bounces again. And similarly right here, it's the same case scenario, by the way. Every time this thing tries to turn red, it pushes. This is NASDAQ, which is futures, but we'll cover that in its own section. This is practice account, by the way, that I'm using to make these tutorials, but not this. This is real. Okay, so here it goes, and it pushes one more time. One more time. Beautiful. Okay. Now, why did I not take a long? Well, for me, I don't think there's enough room to make money, because we already identified that 83.64 is the resistance. There's no point of risking it. So what I'm going to do is actually go short instead of long on this specific trade at the key level. And also, we're looking at the pattern that we believe is forming. Look, this is exactly what I'm talking about when I showed you this pattern. Instant push on the open. We're now 10 minutes in and a downtrend. And that's the exact kind of push that I'm talking about. Instant push by less than a percentage. And it's very bearish when you see something like this, which is why we're going to try catch it here with a short at 83.64. Okay guys, so when you're trading stocks, you're also trading patterns. So you're identifying certain behaviors and you're giving yourself a hypothesis of why you should trade this certain trade based on the pattern that's forming. So there's two common, consistently repeated patterns in the market. There's a V shape and an inverse V, right? This is the market open, by the way, especially for momentum traders. Trading high cap stocks, this is the pattern that forms. This is not for penny stocks, this is high cap stocks. Okay, so what you're seeing here is you're seeing on the first 5 minutes, you're just getting a big drop, just a big line of red. Okay, the moment you see that, think of yourself, or think of it as a trap because the market wants to push to the upside. I'm gonna show you what that doesn't look like. Okay, this is a V shape right here, but that's not it. Okay, now yes, it's a V shape, but that's one of the scenarios that can play out, which we'll explain. But the one I'm explaining to you right now at the start of this video is a big red like this, and it will be followed. And actually, this is a 20-minute play, so this isn't a great example because this was a legit drop. But if there is no news for a specific stock and it just drops on market open, you know, with no news, you're assuming instantly there's going to be a push up to the key level or to the resistance or to yesterday's close. So this is an actual bearish pattern, because when you have a drop like this and then instant recovery, it means it's going to come down before actually shooting up again, right? Because the market doesn't, there's no room for, this is not a bull market we're in. If this was a bull market, we can assume, yeah, okay, maybe this and this will form. But when you see just a big red candle on the open, or just a big red trend, and then you're assuming it's going to do this and push to the upside to test the resistance, well, the next play is, this is where you come in and say, I'm going to enter a trade. The next trade is, I'm going to short this. I'm going to short this because I believe before it goes anywhere, it needs to pull back. So you just made money here in this specific trade. But this is one pattern. This is another V shape. Okay, this V shape, it's a drop and uptrend, but then a zigzag down. Okay, a downtrend forms and it breaks that structure. See, there's two. There is this bearish trend or bearish pattern, okay, which is also regarded as pattern 4, by the way. But in this case, we don't have any news for these. Usually when we have news or specific catalyst, the pattern 4 or the push to the upside isn't as great. But if this goes all the way to the top, like we have here, to test yesterday's close yesterday's close or yesterday's open, then this is what we're looking at, this specific behavior. So this is a bearish pattern. This, we can call it bullish or sideways, because what's going to end up happening after we do the V and then a pullback, one of two things will happen. We continue upwards like this, or we go sideways that way. Okay, so this is a bullish sideways bearish pattern is the next one, and they're both V shapes, by the way. They all start with a V shape. Now when you see that on the open, you gotta start adding in elements to your trade, saying maybe this V-shaped pattern here today is looking the sentiment of the market is very bearish, so I believe this pattern is going to form. Otherwise, bullish sideways, you say, well, there's no news today, the market has been sold off for a while, I don't think the market is going to drop today, and you're giving yourself all these hypotheses. So you're saying after the V, there's a slight pullback and a continuation upwards to break above this level right here. Now this pattern, however, it's 100% bearish. Okay, this is where basically you get an immediate push to the upside, first 15 minutes, and an instant drop. Okay, so the next move is going to be this. Okay, so these are three patterns you will see play out. This only comes up when there's bearishness. You gotta push to the upside immediately and then down. This is the first 5 minutes. Okay, and of course these patterns need to be added with another element, which is price action and the sentiment of the day of the market. So screenshot those and use them in your own day trading. And today you're going to see us trade. But remember, these are with no news patterns. So these patterns happen when the market is flat. There's nothing going on. It's just consolidating, going sideways. So just to confirm to you the pattern that played out in the last trade in this lesson, in this course or category, we had a push to the upside. We took the long position. We reached 83.60, our resistance. But you see how investors and traders got out 15 cents or 10 cents before the resistance or the key level, and we ended up pushing down. So this just confirms to you this pattern that you see. If there is a push on the open immediately up, then expect what? Expect a come down like this. Okay? Now, sure, it did play around and went again to test the top one more time and done a double top. But anytime you see, I'm going to keep this as a lesson, a market open push in a bear market or a market that's scared or a market that's going sideways, a market open push, expect a come down like this. In a bull market, it will be different. Okay? Everything will just start skyrocketing, shooting upwards, upwards, upwards. Because there's just buying pressure. Everybody wants to buy. Here, not many people want to buy. When people see the prices pushing, they take their profit, causing a come down, and it keeps going to the side. Now, if this was sideways, it would be the same, right? It will just be like this every day. So that's just to confirm to you the pattern I've showed you is exactly what happens or exactly how it plays out. Just like this. Straight market open push, hits resistance and comes down. Now, for swing traders, we already know our key level. This is our fair value. We're going to see a push back up at some time to test this period. That's when there is some positive news. Okay? Maybe not today, maybe in 2 days, whatever. We'll have to identify the actual support level on a higher time frame for Amazon. And we know the resistance. And the resistance will be this structure right here if it drops even further. But if it stays at this level, we know the push to follow is here. Okay, guys, this is going to be a crash course on trading futures. We're going to cover a couple of things. And this is to trade the NASDAQ specifically, which is the Tech 100. But you can use these patterns with any market because the behavior and the psychology will always be the same when it comes to trading any asset class. So I want to introduce you first to the patterns that occur. This is a 1 minute time frame or a daily time frame or hourly time frame. So let's jump right into the broker. What we have here, guys, is the NASDAQ 100, US Tech 100. A lot of you using TD365, you can see the same points and the same kind of chart, just to be on the same page. Here's what we have. We have a drop followed by rejection of the previous support, which is here. Okay, let's minus it out. So here is the drop, followed by support held from the previous support level area, which is here. This is the last time it has dropped to that level in months. Okay, so down the line, we wipe out some gains because of some bad news. We're going to reject this level. That becomes support. So you come and map it to the last, look to the left of the chart and map it to where it dropped last, majorly. Okay, and that's your support area. Now that's going to be important because what we want to know with this pattern is if this is a V shape with consolidation, which is a pattern you're going to have not just on a major level. Okay, so this is a 1 minute time frame, which means on a 1 minute time frame we use the support on the 1 minute as well, which is here. like I showed you. So with that being said, a V-shape pattern is, it shows up with most asset classes. V-shape with consolidation. There's a drop, spike, consolidation, minor support, major support. That's the major support that you just seen, guys. Okay, this here, major support. Now, I'll explain to you why we need all of this. This is major support because you've seen, if we look to the left, okay, of the chart, that was the support level. If this was to break, then we really break the neckline and we get to drop even further. So right now, what you have after, and here's the psychology with futures and stocks. The stock market doesn't just drop, guys. It has to recover. It has to create space for new shorts, for new drama, for new news to come out. Because what you're looking at here is this big red candle, if you ended up trading it. This big couple of candles, right? That's a 100-point drop, 250 drop, I believe. If you ended up trading this, you can have your own strategy in saying, well, I'm going to look to buy a recovery on this. And of course, maybe you bought too early. Maybe you bought here. With futures, they move by 200 to 300 points. So they'll cover your ass once you're once you're in profit and the move goes in your favor. Even if you timed your entry wrong, and let's say you're trading intraday, you'll get to cover your behind with profit even. But the point here is, after every major drop comes a recovery. And that's what we have. And then a consolidation period, we said, just like this presentation. We have a drop. My major support has been hit. Now we have consolidation area after spiking back up. Consolidation area is where you really want to look at entering a trade, right? Because consolidation area means there's no more pressure around this area to push, or this area could be used for multiple things. One, if you're looking at a short position, this consolidation area tells you there is no more buying pressure. Again, depending on the price action, which we'll cover in a minute. If this consolidation area is pointing upwards, then you'll know by the price action with the green candle, which tells you there is buying pressure to break the resistance. Now this consolidation area is where you time your short. Okay, this is a perfect place for a short. This here, rejection area, is the worst place for a short. Okay? Worst entry ever. Exclamation mark. Now I'm only pointing towards this. Okay? We all know the market will drop. The market will give you enough points. Here you are. After this, it gets greedy. You get greedy. So after this, the table gets hot because the recovery is coming. We already know this. Why? Well, because that's just the way it goes, guys. This is the psychology, right? This is the recovery we're talking about right here. I mean, if you today ended up short in a consolidation, which is this area. This is consolidation. Okay? And this is all consolidation. It refused to break above this level. Right? Consolidated, big candle coming in, and a further drop showed up. Here, this would have been a gray short. Now, it would have gave you just enough, which is about 100 points, to really walk away from this trade. Even 50 points. To say, okay, I'm comfortable now. Let me walk away, wait for the next time the stock creates space and room before I short it. So what you had here now is a drop followed by a recovery. Okay, of course, recoveries will always be followed by drops, and this is where you can say I'm going to take short scalps. Here's the scalpers coming in. This is where you get the scalp. Okay, and you have more uptrend. Now this is a period of consolidation now. So after we've hit our, you could say, V shape, which is what I just showed you guys. The V shape is one pattern that will always repeat itself day after day on the 1 minute, on the daily. Okay, and here we are at resistance. So this is the resistance. So this has now become our major level, resistance level, which means anywhere near that price, it really becomes dangerous. And this is our support level, major support. If this level is broken, 185, the stock market could go anywhere, even more down, right? But short term, this here is what you're scalping, guys. It's these ups and downs, which will happen, by the way, which is why if you trade and scalp, this is what you're scalping, but you're scalping without news. So that means you have to take the 10, 20 points that's given to you. The only reason this has, caused a major drop was because there was news, right? A drop like this doesn't happen without a reason. There's always a reason. So consolidation level, what is that? Consolidation is what here's an example actually. Okay, here's for scalpers. Here's a consolidation level. Candle rejects. Now this is live as we speak. Okay. Candle rejects further pump. Now the red is coming in. Here is see that, guys? Sideways movement. That failed. It doesn't want to go anywhere. That red candle failed. It doesn't want to go anywhere. But you got to give it more time to push. So, personally, I would have waited a little bit just to see, will it come back up green before I end up shorting it. Now, if this green candle breaks above that candle, then you could say it's going to make a newer high. However, consolidation is sideways movement, as you can see, guys. It's sideways movement. Usually, 8 out of 8, right? It will drop if there is bearish sentiment in the market. But in this case, it's rejecting that level. And yes, it's right above it, but still rejecting it. And there you go. It just made a newer high, guys. Right? So that's price action. We're just looking at the pressure it's given us. Now, it just gave you 10 points. See how it's moving? It just gave us 10 points here if we had entered and it broke. But that's where, the best area to jump in. It's quick in and out, which is TD365. They support you with that. And here is the jump, guys. 20 points as I'm speaking. Now that's where you come in and scalp, right? And there is the major level. Here's the major level, guys, we talked about. This is another consolidation area. If there's no major news, this thing will pull back, i.e. drop. So let's see. Let's have a look, guys. Here, you can prepare a short position because when something happens, when you see a big green candle, then you'll have a small candle followed by a red, right? Sideways movement, right? It does this, then it gets followed by multiple greens. If there is buying pressure, it will continue. However, if there isn't, it will reject and come back down even more. So that's an example of scalping intraday or pre-market or whenever. But this is a V-shape really, as you can see, or you can call it a gap fill if you want. So another example would be the reverse V-shape with consolidation. This is when you have bad news or the market is overextended. It's sold off the day before, and now it's recovering. So let's see if we can find an example on the chart. Well, this will be an example, okay? This recovery in this kind of V shape right here is an example of, and you can call it, and this is an example in the making. So you have a V shape, then you have a reverse. So what you have here basically is this and now this. Okay? Consolidation area, we're seeing it as we're speaking, matter of fact. Here it is. And it happens. Here's the consolidation, guys. That's consolidation. That's inverse V shape. And consolidation happens around, well, major resistance areas or rejection areas, you can call them. And here you go. That's consolidation, guys. So you will always have these plays, but you have to be quick in taking profits. And we can always tell, really, what the market is going to do. So that's an example of an inverse, you can call it. Let's call it inverse V shape. So that's happening as we speak, guys. Here's another example of consolidation, right? But the market is actually going to drop because you can see we've hit the major support level, and there's no news here going to push it upwards. So it just stays within range, and that's what you guys need to understand. It does stay within range. Okay, here it goes. It's going to break that minor support, and then boom. Minor support is just a candle here that are rejected. Once it's broken, then the stock just does a slide downwards. Or this specific index, NASDAQ or any other index you have. And that's price action, really. Of course, if you have good news here or some buying pressure, it breaks this, then it shoots up even more. And then that's it. Resistance has been broken, and there's could go back to whatever by 100 point to this level. So you have to use these in really determining, should you stay in a losing trade? Should you stay in a losing trade, or should you hold on? All right, these are what key levels do to you. It gives you an idea of where risk management should be. Because you don't want to just keep holding on after all key levels are broken and then hoping, oh, maybe it will come back down to the last key level. Right now, especially when the market, there's uncertainty and there's upcoming events that could move the market in the direction you want, yes, you can hold on. But you see what consolidation is, guys? It's just sideways movement. Okay? Sideways movement, no up, no down, it's just this. And it's making up its mind where it wants to go. Doesn't want to do this. Or doesn't want to do this. Okay? So let's go to another lesson. 1 minute time frame. I mean, it's important, guys. You take 10 to 20 points from a drop or a spike. So this here is a spike. It gave us 20 points. You missed the first big one. Let's say you missed the resistance line, and it gave you 10 to 15 points. Right? At consolidation, you walk away. Or before, maybe at this candle at the top. Because you're going to see this a million times. This same thing I'm looking at, you're going to see it. So another example of 10 to 15 points is buying at 14,270, selling at 14,280. Okay? This is short-term scalps. Here, you can take another 20 points on the downward movement. So it's important you have your entry and exits correctly. Take 10 to 20 points on the drop or the spike unless there is a catalyst. Okay? If there's no catalyst, it's not going to push it higher. So you can see this, it wants to really drop, right? It tried again to break above resistance, which is the top, and it failed. So now it's coming back down. Rejection area. A rejection area is where an asset will fail to breach either upwards or downwards unless there's a catalyst. Guys, you are now looking at it, right? This is the rejection area. It failed. It tried to go above and it dropped. Now it tested it again and it failed. So now I can guarantee it's going to drop. All right? Because traders are looking at this and they're saying, well, it failed twice. That means nobody's buying it. It's going to drop. And here we go, guys. Once this is broken, this thing will drop. So, where is it going to stop? Well, it will probably stop right about here at the top. So you'll have about 15 points again. Once it breaks the top, you will get to see the bottom again of the support. So again, I rejected it, guys. So the market doesn't know where to go just yet. So once the thing gets overextended sideways, traders get scared and eventually they dump it. Or they're waiting for buying pressure, or they're waiting for something to happen. Whether a stock market open in some other country to see where the direction is for the day for the world's economy, or for news to come out. Okay, so that's what consolidation. But this is a dangerous area to try and enter unless it breaks the candle. The wick of that candle. You have to always look to the left when making a decision where the wick is or where the candle is to enter or use as indication. So look at the sideways movement. This is an example of consolidation. A rejection area is usually around the daily high or the daily low. That's what a rejection area is, guys. And this is a rejection area. Okay, if we zoom out, 1 minute time frame. Remember, a rejection area doesn't have to be exactly at the figure, which is why a lot of you will get stomped out when you put a stop loss, especially with futures. A rejection area could be just above it or just under it. So that's why it's important to have a wider stop loss when trading futures. This is a rejection area. This is the top where it dropped and the gap has been filled. And here you are. You have this consolidation around this. The market wants to know, shall we break above or shall we stay under it? Given the bearish sentiment, I believe we're going to stay under it. And that's how I make up my decisions. The best entries at consolidation and rejection area when candle shows pressure to go in that direction. Now, entries, guys. Here is where your entry should be. If you're going to short something, you're going to short it right about here. Right? So you can take advantage of the drop before it happens. If you're going to long something, you're going to long it at the top when it breaks. But you don't want to short at the bottom after you've missed a big drop and then you end up shorting. So now you're bag holding for the whole day and the market still hasn't even came to your entry point. No, you don't want to do that. If you see big reds coming in, expect always a reversal. If you want, you can short here. Then it could go against you. Then add more. If this comes down, then you end up with what? This is an inverse V now. You end up with a profit, even if you timed your first entry wrong. But you don't want to catch the bottom. Of course, you don't know when the bottom is. Well, ideally speaking, you will have a big red candle followed by another red candle followed by another red. And then boom, that's it. Support gets held. And that's why you will see a lot of dead cap bounces. If there is more selling pressure, it will break even below further causing a further drop and then another recovery. Okay, but if you can take the first two red candles if you're shorting, that's good. If you can take the first two green candles when you're buying, that's good. The major big ones, of course. So that is the best entry. Futures can be held long term if you're experienced in market sentiment and ranges. So you can hold your loss for a period of time, guys, if you're experienced in market sentiment and ranges. What is a range? Well, this is a range, guys. This right here is a range. The market wants to stay within range, i.e. it doesn't want to drop, it doesn't want to go up, it just wants to stay within range. Unless news comes out and it pushes it even higher. That is range. If you believe the market is going to stay within this range, but after staying within this range, it's going to come out with some bad news, then you can say, well, after the bad news, it's going to drop back to my entry point, which let's assume you're the worst trader ever, and this is your entry point. It's the bottom. Okay? Then that's when we use ranges. And sometimes you can hold a bad trade, but the moment it breaks above that range of yours, start worrying, guys. So again, ranges can be used to use a stop loss, really. A mental one if you wish. What are ranges? When there's too much uncertainty or when there's overextension, market will stay within range. So let's say the market is overextended, i.e. it got sold off severely, like you see here. Well, it's going to try to, recover, but stay under it until something happens, until big news or something pushes the market further. And that's usually news. So it will stay between the support and resistance and will fail to break above. And we're seeing this currently, guys, as we speak in this scenario, which is perfect. Okay, this is our resistance. This is our support. It doesn't want to break above it unless news comes out, forces it to break below or to come down because the market is too bearish or there's too much fear in the market. That's for futures. So we usually will close near or open near support or resistance. Base your trade there. Okay. Best entry, guys. Best time to enter. Well, there is no best time to enter. Sometimes your timing is wrong. Sometimes your timing is perfect. But this is the best time to enter when it starts downtrending like this. You can say there's overextension and doesn't make sense, or the price action is telling you it's coming down. So that's your best entry, really. Grab a scalp, walk away. But again, here's what to avoid. Do not enter around after a market sold off significantly and got overextended. Right now, this thing, you can call it overextended on the long position. So this is a overextension, guys, on the long. Why? Well, because that green candle in a market like ours, when I'm making this video, we're on the brink of war. So there's a lot of fear. There's inflation too. So that's an overextension of a long position, really. So it has to come down. So risk management is something I think you're going to have to base on your style of trading. If you get stuck holding a position in a loss, you might decide to hold it based on your upcoming events you believe will push the market in your direction. So if you're in a loss today, you might hold that loss because you believe what's about to come up, and you know the date, you know the timing because you were told online, will cause the market to suffer and drop because of fear of what might come out in that news, or because something, you get lucky and something comes out that pushes the market in your favor. Now, of course, this is a bit of a risky strategy, works 50% of the time, but sometimes the stars align, because if you ended up shorting and the short goes against you, you shorted for a reason. Well, because you believed the news was outrageous, and usually when the news is outrageous, you will have more selling pressure even after a recovery. And sometimes you might decide to only stick to scalping futures, taking 10 to 50 points. Now, you might try to scalp a breakout, a drop, which means you will need to take the same loss, of course. The better your entry, the better your time, and it reduces that risk. So it's more like a 1-to-1, but again, with your entry, you make it 10-to-1, right? If your entry is good, your risk is minimized significantly. So that's it, guys. That's all I wanted to show you and share with you. Consolidation areas like this really is where personally I come in to look at some red candle, big candle, and I'll short it. But futures are very attractive and lucrative, and make sure to manage your size position, or your position size when trading. That's a 30-minute video, guys. Hopefully you enjoyed this. See you soon, and keep practicing. Never give up. This is a very rewarding business, guys. If you get it pinned down, you will get it done. Once you understand the emotions, once you understand the psychology, and it will take you some time to understand all of that. Making consistent profits in one bad trade wipe you out. That's okay. That's a lesson of what not to do next in the next time. Okay? And don't over leverage, please. See you soon.